Welcome back to session 5. In this session, we will be looking into both fiscal and monetary policy, as well as stabilization policies. So when we are looking into the fiscal policies, we have the demand side effects. So these are really things that the government can do to shift the AD curve. So fiscal policies involve change in tax. They can provide subsidies. So these are payments to, for example, subsidize education, as well as government spending. So for example, spending on paving highways. So consider an economy that is currently in recession. So as we can see, this is the Y potential, so the full employment output, and currently the economy is operating at this point A. So we say that there is a recessionary gap because the economy is currently producing below its potential level. So an increase in government spending would shift the AD curve to the right. So what the government can do is increase government spending and shift AD curve to the right, so the economy is back to its potential output level. A decrease in income or business tax would also shift the AD curve to the right, as well as increase in welfare and subsidy payments would also shift the AD curve to the right. So these are known as the demand side effects. However, we will run into the problem of crowding out again whenever the government runs into a budget deficit. Okay. So as government increase their spending by borrowing, or you can say that tax collected, so tax revenue collected minus government spending is going to be negative. So in this case, what will happen in the loanable funds market is the savings curve. So the supply in the loanable funds market will shift to the left due to deficit. So what we are going to see here is that the interest rate is going to increase. And again, we are just assuming these investments equals to savings. So investment is going to decrease. In the money market, when the AD curve shifts right, so when AD curve shifts right, both price level and real GDP increases. This will lead to an increase in money demand. As nominal GDP, so these are really nominal GDP. So as nominal GDP increases, consumers are going to demand more money for transactions. So what happened in the money market is money demand will shift to the right. And this is consistent with what we see in the loanable funds market. Interest rate is going to go up. Okay, so as interest rate goes up, this will shift the AD curve to the left. So it will partially cancel out the initial shift So initial rightward shift of the aggregate demand curve, which is from increasing government spending. So as interest rate goes up, the AD curve is going to shift to the left. So hopefully not as much. Otherwise, the fiscal policy would be completely ineffective. So now, what if the government uses a balanced budget approach to financing its spending? So for example, the government increased spending by $1,000, matched with an increase in taxes by also $1,000. So in this case, the government would not be running into a deficit. It would just be balanced. So let's assume the marginal propensity to consume is 0.8, and we know that the multiplier, the spending multiplier, is just going to be 1 over 1 minus MPC, which in our case is just going to be 1 over 1 minus 0.8. So that's 1 over 0.2, which is 5. So with an initial increase in government spending of $1,000 times the multiplier, the net effect, the total effect will be $5,000 on the government spending. How about the effect on the increase in tax? So the key is this initial decrease in consumption is going to be, so first of all, you have negative 1,000 from the tax, and then times the MPC, which is going to be negative 800. So this is how we get this negative 800. And then we just times the multiplier to get a total overall effect of negative $4,000 decrease in real GDP. So the net effect, it will be 5,000 minus 4,000 when the government uses a balanced budget approach. So what we are seeing here is an increase in government spending with an increase in tax. So this is by 1,000, an increase in tax by 1,000 is going to give us a net effect of increase in real GDP of $1,000. So in this case, we say that the balanced budget multiplier is 1 because the overall effect of increase in government spending is the same as the overall effect in GDP. So these are the formulas. Remember, the spending multiplier is 1 over MPS, which is the same as 1 over 1 minus MPC. And the tax multiplier, in this case, it has to go through MPC first and then times the multiplier. So this is the same as MPC over MPS. So again, this spending multiplier is bigger and the tax multiplier is smaller. So the balanced budget multiplier is just the spending multiplier minus the tax multiplier. So spending multiplier is 1 over MPS minus the tax multiplier is MPC over MPS. So here we have same denominator. So we can just rewrite this as a single fraction. And we know that 1 minus MPC is the same as MPS. So this is why the balanced budget multiplier equals to 1. So now we move on to look at the supply side. So these are things that the government can do to shift the short run AS curve as well as the long run AS curve. So in order to shift the long run AS curve, we need to increase productivity by enhancing factors of production. So again, the factors of production are human capital. So these are the education, size of labor force and skills of the laborers. So what the government can do is they can subsidize education, lower interest rate on student loans, or even lower tax on income. So when they lower tax rate on income, people are going to work more. People are going to work more. Because the after-tax income has increased. Physical capital, so these are tools and machineries. So what the government can do is they can impose business investment tax credit or even business tax deductions. So business tax deductions to encourage business to invest into tools and machineries. Natural resource, so you have land, timber, oil, or even fish. So what the government can do is they can implement sustainable policies to ensure that the natural resources do not deplete as much, or even if for example, fish can reproduce. And then finally, we have technologies. So what the government can do is they can subsidize innovation program by business and universities. So all of these factors of production requires an initial investment. And really, the government can encourage investment by encouraging savings, because this will lower the interest rate. So when real interest rate is low, then you'll see businesses wanting to invest into physical capital and technology more. So when interest rate is low, this will also shift the AD curve. And when tax rate is low, this will also shift the AD curve. So a lot of the time when we look at things that shift the AS curve, a lot of the times it will also shift the AD curve. So just keep that in mind. Okay, so for example, the government encourage saving. By, let's say, savings tax credit. So the government is going to tax less on the savings income. So what we are going to see here is, first, in the loanable funds market, the savings curve, the supply curve is going to shift to the right. Well, that's also the savings curve. The supply of the loanable fund is the savings curve. So as interest rate goes down, what we are going to see is investment goes up and AD shifts right. At the same time, as interest rate goes down, due to the increase in investment, so in physical capital and machineries, productivity is going to increase, because now workers have more tools and machines to use to produce goods and services, and this will also shift the short run AS curve to the right, as well as the long run aggregate supply curve to the right. Okay, so again, we are assuming the same example. Currently, the economy is in a recessionary gap. So what we are going to see here is, so again, we have saving tax credit, which lower interest rate. Investment goes up, AD shift right, and then AS shift right, and long run AS also shift right. So this is really what we are going to see. So AD shifting right, so at point B, and then AS is also going to shift right to point C, and then finally the long one AS is also going to shift right. So this is the new potential output. So this is probably the best situation we can see. We are producing at a much higher level due to the supply side effect. So if we can shift the long run AS curve, the economy will be able to produce a lot more than before. So this is also an hour shift of the production possibility frontier. So for the supply side effect, focus on the interest rate. When interest rate is low, businesses are going to invest more, and as they have more and more capital, the economy as a whole will become much more productive and shifting the long run AS curve to the right. Okay, so now we are going to go over policy mix using both fiscal and monetary policy. So again, we are still using the same example. The economy is at point A, currently producing below the potential level. We have a recessionary gap. So let's say the government increases government spending and the central bank increases money supply. So increasing government spending is a fiscal policy, and increasing money supply is monetary. So just a recap, the Federal Reserve, the central bank, can increase supply either by buying bonds. So when they buy bonds, they give the money to the hands of the public. They can lower the discount rate, or they can lower reserve requirements. So when they lower discount rates, they are encouraging banks to borrow from the central bank so they can lend out more money to the public. When the lower reserve requirement is the same thing, banks now have more loans available so they can loan out more money to the public. So what we are going to see here is fiscal policy increasing government spending. AD is going to shift to the right. And at the same time, when AD shifts right, and we know that savings is going to decrease, which will drive interest rate up. So this is supply and demand for the loanable funds. However, with the increase in money supply, this is going to shift the savings curve back to the initial position. Because now bank has more money to lend out, so the supply of loanable funds increases. So this can hopefully cancel out the crowding out effect and make sure that the economy stays at B, at its potential output level. In the monies market, you will just get the same picture. So as money supply increases, the central bank are able to influence the interest rates. Okay, so the government and the central bank can work together to implement fiscal and monetary policy to eliminate the crowding out effects. Oh, I have two graphs here. So I'll give you a complete picture. So government deficit shift the savings curve to the left. And then here in the money market, when government spending increases, AD increases, so this will shift the money demand curve to the right. So these are the same interest rates. And then because the central bank is shifting the money supply curve to the right by increasing money supply, so hopefully they can make sure that interest rate doesn't change. So we are going from point A to B and then to C. Okay, so initially interest rate has increased because of the increase in government spending, and then the central bank, by shifting the money supply curve to the right, they are able to influence the interest rate back to point C. So they can make sure that the interest rate stays the same. On the normal funds market, this will just be shifting the supply curve back to its initial position to get to point C here. Okay. So as illustrated above, with a mix of policy, it may be possible that the government can close a recessionary gap in our example without having the drawback of crowding out. And this method can also be applied in an inflationary gap. So government deficits and debt, they are totally two different things. So deficit is accounted for yearly, and debt is really the accumulated amount of previous deficits. So that government deficit occurs when tax revenue collected in a year is less than government spending, and the accumulated amount of deficit over time is called the government debt. When government wants a surplus in a year, the government can use the surplus money to repay previous government debt. So the key is deficit and debt are two different concepts. In the US economy, many automatic stabilizers. So automatic stabilizers are really policy in place that do not need approval from the government. So for example, whenever there is a recessionary gap, welfare payments is going to increase, so they are very built-in and automatic. So when the economy suffers from a recession, layoff workers will receive employment insurance payments as well as welfare payments. So in this case, government spending is going to automatically increase. And when income is low for business and individuals, they will be taxed at a much lower tax bracket, and this will decrease in tax. So what we are seeing is when there is a recession, government spending is going to automatically increase through welfare payment. And you will see a decrease in tax because of lower tax bracket. And when the economy is overproducing, there will be less welfare payments paid because, so when government spending increases, sorry, I'm going back to the previous point. When government spending increases and tax decreases, the government will be running a deficit. So during recession, the government is going to run a deficit because of the built-in policies. And when the economy is overproducing, there will be less welfare payment paid because less people will qualify for such payments. So in which government spending decreases, and when income is high, firms and households will be taxed at a much higher tax bracket, resulting in a budget surplus. So automatic stabilizers, they do not prevent business cycles, but they help to ease off the effects of business cycle. So they prevent from a recession going to a depression, and an inflation to going a hyperinflation. So during these inflationary, and then that's recessionary, that would be the potential output level. So during this time inflationary, you will see government spending decrease and tax increase, which lead to a surplus. And then during recession, you will see government spending increases and taxes decreases, which will lead to a deficit. Okay, so let's go over some exam type problems. Which of the following is equal to 1? So the spending multiplier is 1 over 1 minus MPC, or it is just 1 over MPS. And this is smaller than 1. It's actually in between 0 and 1. The tax multiplier is just MPC over MPS. Sorry, that is not smaller than 1. Yeah. So, sorry, the spending multiplier is most of the time greater than 1. Unless MPS is 1, which would be crazy. So you save all your income and you do not consume anything. Tax multiplier is MPC over MPS. So as long as consumption is bigger than savings, this should also be bigger than 1. The money multiplier is 1 over the required reserve ratio, and again this is bigger than 1. MPC over MPS. Well, MPC over MPS is the tax multiplier. So again, it's bigger than 1. The balance budget multiplier equals to 1. That's correct. So the answer is E. Which of the following statement would the supply side economists agree? So tax changes cause shifts in the AS in the opposite direction with AD, reducing the net effect on real GDP. Is that true? No, that is not true. So price level, real output, AD, short one AS. So again, when interest rate decreases, AD is going to shift to the right, and short one AS is also going to shift to the right. So they are actually shifting in the same direction. So this is A. After the AD shift, we have B and then C. So in terms of output, we can see every shift is contributing to an increase in real GDP. So A is not true. So they would disagree with A. Tax cut is likely to shift the AS curve to the right by increasing savings, investment, and physical capital. That is true. So when there is a tax cut, the savings in the market for loanable fund is going to increase, interest rate is going to go down, and the AS curve will shift to the right. Mainly because now laborers become more productive by having more physical capital. So C, increase in income tax will discourage workers from working. That is also true. So when there is a tax cut, more workers will enter the labor force, and this will also shift the AS curve, both long one and short one. Tax cut will encourage business to take more risks. That is not true. Well, that is true actually, yeah. So if the tax rate on business is lower, business are willing to invest into more projects that are more risky because the reward is greater. A tax cut does not mean a decrease in tax revenue. That is also true. As you can see here, real GDP has increased by a lot. So even if individuals and businesses are being taxed at a lower tax rate, the overall effect might still be the overall effect might still be greater on taxes. So although the tax rate is lower, we are looking at E. Although the tax rate is lower, but because output is more now, income is higher, so the overall taxes that the government can collect might increase. Fiscal policies involves either change in government spending, taxes, you can even think of subsidies program. So tax cuts to fight inflation. So when there is inflation, so let's see. Okay, so let's say currently the economy is overproducing and there is an inflationary gap. So if there is a tax cut, this will shift the AD curve to the right, and this would not help in this case. If you shift it to the right, price is just going to increase. So that is not true. Tax hike to fight recession. So if we have a recession, so if you increase in taxes, AD curve is going to shift left. So that is also not true, because in this case AD will decrease. Changes in government expenditure and taxes in fighting business cycles, that's true. Budget deficits and budget surplus is not really fiscal policies, they are a result of fiscal policies. So the answer is C. A budget deficit occurs whenever tax received minus government spending is negative. So you can say whenever taxes received is less than government spending, or you can also say whenever government spending is greater than taxes. So export, exit, import, no. Import, no. Real interest rate, no. Government spending exceed tax revenue, yes. So whenever government spend more than they collect, they will be running into a budget deficit. The appropriate fiscal policy to fight a boom, so inflationary gap. So what we want to do is shift the AD curve to the left. So we want to decrease in AD. So this can be done by either decreasing government spending or increasing taxes. So cost for federal government to run a deficit, no. So when there is a boom, the government will automatically be running a surplus because of the automatic stabilizers. Cost for federal government to run a surplus, that's a yes. Increase taxes, okay, that's good. And increase government spending, no. We want to decrease government spending. Decrease in taxes, no. Decrease in taxes, no. So the only correct answer is B. The appropriate fiscal policy to fight a recession. So when there is a recession, we want to increase government spending and decrease taxes to shift the AD curve to the right, and this will lead to a budget deficit. Calls for the federal government to re-elect its president, no. Calls for the federal government to run a surplus, no. Increase in taxes, no. Decrease in taxes, yes. And increase in government spending, yes. No. That is a decrease in government spending, so that's a no. Decrease taxes, increase government spending. So the answer is E. To close an inflationary gap, so economy overproducing is inflationary. Potential at this point, YP. So to close it, fiscal policy can shift the AD curve to the left. And what they can do is they can decrease government spending and increase in taxes. AD curve shifts right, no. AS curve shifts left, no. AD curve shifts left, yes. AS curve shift right, no. Prices should be lower, no. So the best answer is C. Well, in this case, we do see that prices is lower due to a leftward shift of the AD curve, but the fiscal policy has no so it doesn't really has control on price level. It's more on the monetary side when we increase in money supply. Okay, so one drawback of using fiscal policy to close a recessionary gap is that, so we have recessionary gap, AS, AD, long run AS. So remember, you can shift the AD curve to the right. However, this will, so we are increasing government spending, decreasing taxes, deficit, which will shift the supply on loanable funds left, and this will drive interest rates to go up, which will shift the AD curve back. So one drawback is the crowding out effects. Oh, okay, let's look at the choices here. So employment will rise. Well, that is not a drawback. Employment rising is good. So here from A to B, employment is going to rise because we are producing back to the potential level, so more laborers will be hired. Unemployment will rise. That is just not true. Unemployment will actually fall. Cuts on other government program, that is not true. The government will just be running in a budget deficit. Real GDP will be lower. That is not true. Real GDP will be higher. However, in this case, we can see that price level has risen. So we can argue that that's one of the drawbacks, because if we were to shift the supply curve, right, instead of shifting the AD, we can shift the AS curve by having a tax cut, encourage business investment and technology innovation. So we can do that, and in this case, price level will decrease. So when price level decrease, the value of money, dollars that we hold in our savings and checking accounts will increase. So that is probably good for the citizens. However, shifting the AS curve will take a longer time. So it takes a longer time to be effective. So the answer here is E. Stagflation occurs when price level goes up and unemployment rate also goes up. So that is the worst case scenario. And this is due to a cost push inflation. Right, so this will only occur with a cost push inflation. So that is probably the worst that can happen. Price level went up and unemployment rate also went up. So employment and price level increases? No, we want unemployment increases in stagflation. So employment and price level decreases? No. Unemployment and price level increases, that's true. So the answer is C. Study the diagram below. So what we can see is in the short run equilibrium we have a recessionary gap. Economy is in long run equilibrium. That is not true. From the previous session we know that the short run AS will shift to the right in the long run if the government does not intervene to restore back to equilibrium. And this is because that because unemployment rate is so high, so there will be more factors of production available, for example laborers, and they will be willing to work at a lower wage, and this will lower cost of production for firms. Therefore it will shift the short run AS curve to the right. So AD curve shifts right in the short run. That is not true. AS curve shifts right in the short run. That is not true. Only in the long run AS curve will shift to the right. This economy is in a recession. That is true. This economy is at its peak. That is not true. So the correct answer is D. Automatic built-in stabilizers, they do not prevent recessions and inflationary gap. They only help to ease off the effects. Prevent overheating in the economy. So again, they do not prevent anything. Prevent inflation, no. Government policy in place to promote budget deficit in recession, that's good. Promote budget surpluses in expansion, that's also good. So the answer is D. Which of the following would not be an example of contractionary fiscal policy? So contractionary fiscal policy means they are wanting to shift the AD curve to the left. So they can do this by decreasing government spending or increasing taxes, or both. So decrease money spent on welfare program, that's contractionary. Increase in income tax, contractionary. Increase in business tax, contractionary. Increase money spent on repaving highway. So this is really increase in government spending, which is not true in a contractionary case. Running a budget surplus by decreasing government expenditure, that is also contractionary. As government spend less and collect more taxes, they will be seeing a budget surplus. So the answer is D. In the period of an expansion in business cycle, the automatic stabilizer will have what effect on tax revenue? Okay, so expansion, when we have an expansion, government spending is going to decrease, taxes is going to increase, and we are going to get a surplus. So taxes decrease, no. Tax increase, yes. Amount spent on welfare, that's government spending, so we should see a decrease, that's a no. So tax increase, government spending decrease, and surplus. So the answer is D. Which of the following fiscal policy is likely to be most effective to close an inflationary gap? So inflationary gap, we want to decrease government spending and increase taxes. So decrease taxes, no. Increase taxes, yes. And keep spending unchanged. So this is a maybe. Increase spending, no, we want to decrease government spending. Decrease government spending, yes. Match with a decrease in tax, no, we want to increase taxes. Increase taxes, yes, and decrease government spending. So that's the best answer, E. Which of the following would not contribute to economic growth? So in order to contribute to economic growth, we need to focus on factors of production. And in order to invest in factors of production, we need the interest rate to be low. Or we need subsidies from the government. So low interest rate student loan, that's good. This will encourage students to obtain a higher level of education, which will enhance productivity. Tax free on income earned from savings. So this is encouraging savings, which will lower the interest rate. Removal of investment tax credit. This will discourage investments. Research grant given to college and university, that is a form of subsidies, so it will encourage technology improvement and innovation. Environmental friendly policy to manage renewable harvest of fish. So that is also good. That's for natural resource. So the only one that would not contribute to economic growth is a removal of investment tax credit. To close a recessionary gap, the government has decided to lower taxes. What happens in the loanable fund market, interest rate, and the demand for money? Okay, so when tax rate is lower, so what we are going to see in the loanable fund market is that the supply of loanable fund is going to shift to the right, because now people have more money. They're going to spend a portion of that according to marginal propensity to consume, and the remaining they're going to save. So interest rates, dollar, supply, loanable fund, demand, loanable fund. So supply is going to shift to the right, and what we're going to see is interest rate is going to fall. Okay, so how about the demand for money? So money supply and money demand. So what we are going to see in the money demand, well, first of all, when tax is lower, what we are going to see is AD is going to shift up due to the increase in consumption. So first of all, money demand is going to shift up. So what we see here is an increase in interest rates. However, yes, so actually that's all we need to answer this question. We do not need to go any further. I don't want to make it too complicated. So here, loanable fund market supply will increase. So that is not true. So supply rises, interest rate will fall, and the demand for money increases. Yes, so the correct answer is B, not A. So the long run average supply curve is most likely to increase as a result of, if you increase the interest rate, this will discourage investment, so no. Increase investment in capital, that's a yes. So more tools and machinery available for the labor force to use. Increase in AD, no. Increase in long run AD, there is no long run AD. Increase in government spending, that's a no. So the best answer. So that's the end of okay, so that's the end of into the and in the next session we are going to be